Hey there, welcome to the channel. So today I'm just gonna, not really gonna do a lot of stock stuff, just gonna, I don't know, play some Minecraft or something like that. So let's see here. Take a minute here to go to a weekly chart of the S&P to kind of see where we ended up. You know, it's very interesting. If I look at things over here, you know, there's a lot of talk. You see where the gray bar is highlighting that. This is kind of for the week, you know. I mean, it's really kind of funny. So if you look at the SPY, you know, ETF for the S&P 500, really nothing really happened that much this week. Nothing. I mean, it is kind of still riding up the moving average on the weekly. It's really nothing much going on. So it's amazing that how many times I've seen, you know, videos from people. You know, it's like market crash, and it's like, well, yeah, it's crashing, sure. You know, it's crashing because you're in all high betas, like micro cap stocks, and that's why it's crashing. Even the Nasdaq, like Nasdaq, is definitely doing worse than the S&P 500 for sure, but it just, I mean, it's still not really in the scheme of thing a big picture. Like that's kind of a similar bar to over here, which didn't mean a dang thing, right? This bar over here, we basically recovered and kept going up the trend. I mean, the big picture is the trend. Where should we be going? Are we going with the trend or against it? You know, let's look at the 10-year yield because we're talking about rates. This is the big thing, the rates. Oh my gosh. It's funny because even here, the Van Meter was like, oh, the Fed screwed up this week. You know, they should have lowered rates or should have came in and did some buying to lower rates. And I would suspect that they did. Like if you look at what's happening here, rates are coming down, rates basically crashed. So this is the yield on the 10-year. You know, the lower it goes, the higher the price, more money going into bonds. And so what's happening is the yields are going up over here in this period of time. You know, people are getting out of bonds. And of course, that sort of indicates that people don't want bonds. And of course, that's sort of a problem potentially because we need people to want bonds because we have God knows how much trillions of debt we need to keep rolling over and keep adding each month. You know, it's kind of interesting because people talk about how, you know, yeah, that maybe the Fed messed up. They should have, but look at, they did kind of realize. I'm looking at the week as a whole. It's like, yeah, see that high wick there, they knocked it down. So they basically realized it was going out of control. Someone realized, or it just got overextended and they kind of knocked it down a little bit. But it's kind of like, it's still kind of a mess. So here we'll just draw some trend lines. You know, trend lines are not, you know, trend lines are not a perfect thing. They're just kind of an estimate to help you, you know. So if you're ever watching, you know, someone and they're like, oh my gosh, it went over a trend line or broke a trend line, and they're talking about how significant it is. It could be. It's something to observe and pay attention to. But at the end of the day, it's just sort of a reference. It's sort of a way to make sense out of the chaos that is the market. So here we see that, you know, the yields on the 10-year were coming way out, starting to come out of the trend line. And so, you know, you could make a supposition here, like, for example, if you were maybe trading a channel, you know, you would try to buy some every time it touches this channel, and then you would have to try to sell some as it touches the top. Now, if you were doing that kind of trading, maybe you would be like, look, I buy some when it touches the bottom channel. And first of all, maybe you wouldn't start doing that till you have 3 points. So you have 1, 2, 3. And so at this point, anytime it touches the channel here, you would have to fight with yourself because you might want to buy. And maybe you did, but then it kind of reversed. So, I mean, it's not easy, but, you know, if you were buying the channel, then as soon as it goes up some, you have to sell it all. Then here it comes down, kind of goes up, and this is really like this kind of flagging pattern where it has this up day and then it can't move and it just kind of stays in a narrow range, and then boom, it hits the moving average, which comes up, hits it, sell. You know, all this stuff is kind of just it's kind of like people, we just naturally kind of post fit. Like in engineering and science, you take a curve, you take a bunch of data, and you try to fit an equation to it. And this is, of course, very useful because if you can fit an equation to it, to the data that you have, it kind of, from that equation, you can learn, like, try to get an idea of what mechanism is working underneath to cause it, right? You're trying to get to the cause of why the data is happening, right? Well, we overdo this in stock trading. That's what the point I'm trying to get to. You know, you try to overfit, and all this stuff is overfit. You know, people with their moving average crossover systems, here you have a stochastic. Oh, it's overbought, sell. Oh, it's underbought, you buy. A lot of the time it's like, whoop, boom, it's like overbought, not underbought, and not oversold, right? It didn't even make it to the halfway. I mean, and then the reality is this is what's called a stochastic slow K. It's got a 10-3, right? So some kind of, I don't remember. I used to know this, but you know, you can basically create a stochastic of anything you want. Pick any number of days of averaging and any moving average, whatever. Same here with the RSI. It's RSI 14. Make an RSI 16. What does the numbers look like? Yeah, you know, that's kind of what, like, a lot of people that are like, oh, just follow my buy sell signal. Like, okay, I get what you're trying to say. I appreciate that. And that's if you're following Kevin and he's just buying stuff when it's up 10% for the day already. He's like, oh, time to buy more. Or he's buying when it's down 10% for the day, and he's buying more and he's already down $1 million. It makes sense then. Fine, just use the damn RSI 14 or 15. It'll probably serve you better than anything else. So go with that. Okay, so I think I would overdid that. So the high beta stuff. So I have some Tesla going on. I bought a put back here at some point. I think I'm up on it right now, but it definitely didn't do what I thought it would do. It did recover today. And so it did have some recovery. And I think the recovery, when I looked at it, it was because of, like, it looked like Bitcoin kind of recovered too. So basically today started down, came up, and then kind of just blah, kind of finished out. So, and then the other one I was thinking of, I totally forget what this one was. GME. Oh, GME. Yeah, this is funny. So I have a put that's in the money now because I bought it somewhere in here and it's in the money now. So let's look in details at this thing. Yeah, this kind of, it gapped down and then it kind of went up and then it really sold all day. And this is definitely a case of one of these things. Like, I'm holding on to it. I'm like, look, this thing comes down into this gap, it fills the gap. And then, like, there's really not a lot of support here at all. And, you know, the thing with that is I'm like, well, is it going to go lower? I mean, you know, what's interesting with GameStop here is you kind of like, well, it just oversold. It can only move so much in a day before it's just like, look, people that were shorting it, blah, 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 a certain amount are going to cover. And that's what happened here. So I still held on to that. It's a very small position, just kind of see what happens, see if it has some more downside to it. Because like I was saying, this is just not a great setup over here. You have a really strong day, decent volume. Here you have a strong day. Oh, really high volume, but most of the volume was down. It reversed. It opened up high at the top and then closed down. So yeah, it still maintained. The close was still above the previous day's high, but I mean, when you look into that day, and that's kind of where you get into the intraday charts, is like you ended up really having a lot of selling pressure in there, a lot of it, you know. And then so kind of today was this sort of probably a more neutral kind of bar. It's not a doji, but definitely it was like went higher, went lower, had a range, blah, 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 kind of more indeterministic. So I think that, yeah, that's it for the stock market today. think on to more important things here. Trying to dig a hole and doing some diggy. It's kind of funny. So let's see, try to get old diamonds here. Okay, let's see. I need to get some stuff. Let's see what's going on here. Do you think there'll be lava up there? I don't know. Yeah, so it's kind of funny how, you know, I guess yields are the big talk of why the market had some of the corrections that it did, like, you know, the 10-year yield going up. And like, I get it from the point of view that, yeah, look at rates. We are in a position that both as individuals, as people, have too much debt. Corporations have too much debt, and the government has way too much debt. So, you know, none of these groups, which is pretty much the entire population of the country, can tolerate increased interest rates of any amount. And because of that, you know, any interest rates going up, of course, causes concern. Now, it's somewhat arbitrary, though. It's like, well, what is the rate that matters? Well, the only rate that matters is when some traders decide that it suddenly matters, and that seems to be what it is this week. You know, I mean, I really don't know. I know when you look at the data for the holdings of you know, U.S. Treasuries and you know, like some countries like China, they haven't been accumulating them for very long at all. I mean, they've stopped buying them, and there's some countries like Cayman Islands and other countries that are like, really, these countries don't have any money. They're not buying these, and there must be some kind of holding accounts, and you just kind of wonder who's holding them. Of course, I think the speculation is that it's really the Fed having, you know, somewhat secret accounts somewhere that they're using to buy. And, you know, as far as the Fed, I mean, the Fed can just make money out of nowhere, so it doesn't really matter. So they're the one entity in the world that could get away with it, right? They could do whatever they wanted to do, right? Because they basically, I mean, even when they audited the Fed, it was a hard thing to do to get the little bit of the audit they did get. And at the end of the day, they didn't get much at all. So, yeah, so, I mean, I get the concern about interest rates. You know, it's interesting because you have like Van Meter's out there. He's talking about how this Fed screwed up this week. And so, you know, you could say, look at that and say, yeah, you know, I see what he's saying, because he's like, you know, it seemed like from what I heard today, it was like his view is like, well, the Fed should have come in and knocked the 10-year rates down, right? By buying. That's how they would do it. More buying pressure will reduce the rates, right? And but the Fed didn't, or maybe they did, but they didn't do enough, and so the rates went up. And that's like fine, but yeah, it's kind of sketchy. I mean, definitely this week you had a lot of stuff going on with the high beta stuff. There was a lot of like the Wall Street bets, high beta stuff. There was a lot of selling. There was a lot of damage done. And I think, you know, it's something to keep in mind, because you have a lot of people that are betting as part of these things, and they don't have a lot of resources, you know. So when they lose that money, they don't have any more money to put in. You know, I mean, like, you look like a Me Kevin guy. That guy's got more money to put in. But, you know, it's funny. I've just never seen anything like it. He's like buying, and he's buying more. He's like, oh, it's down, it's buying more. And I was telling you this story on like one of my other videos. I'm like, hey, you know, I had this friend, and this friend hired this professional money manager. I think it was like, I don't know what company it was, but it was a big one, like a Morgan or a GS or something like that. You know, he got, and I'm sure he was like, oh, this is awesome. I got a big money manager to run my money, right? And like I said, and this person ended up cleaning him out. And it certainly wasn't the intent. That wasn't the intent. If you looked at it at the time, you could say, hey, this person making great moves. But the reality is what the person was doing was averaging down. And averaging down is a losing proposition. Basically, this person was like, oh, if these stocks like pet.com or whatever drops by 50%, then it's going to be a huge deal. I'm getting a huge bargain. And sure enough, he gets all these fills at 50% down, 60% down, and then the companies go bankrupt because there's nothing there. And so you have to play at all these dimensions. And definitely, it's for sure like these, you hire a professional money manager, you got to keep an eye on them. And that's why one of the things that I would do, like, for example, I've done things where I like considering entering into a partnership with people, an LP or an LLC, something like that. So the first thing that you're going to do is you're going to read everything you can about it first. So if you're going to like get into business with someone, you're going to first of all try to know them is the most important thing. But then in terms of the business side, you're going to try to know everything you can about whether it should be an LLC, S Corp, C Corp. You want to know everything, because if you're sitting there and you go to a lawyer to set up something and you don't know what an LLC is, you just wasted a bunch of money for no good reason, because you should know the basics. You should know the basics of everything before you go into it. So when you're talking with a lawyer, business, accounting as well, finance, all that stuff, there's no reason. It's just, forget it. There's no reason that you shouldn't already know the subject pretty decently. Yeah, I mean, you should know it. And then you get the real value of these professionals, because a real professional will, realize like, oh yeah, you know what you're talking about. And it's like, and then you get to what you're really paying for, which is the experience, and be like, oh yeah, no, yeah, that LLC, yeah, theoretically, that LLC does provide you liability protection, but hey, let me show you this case and that case where, oops, they pierced the corporate shield. And then you get to the real stuff of like, oh, this is how it works in practice. So you may want to consider doing the LLC in a different state. But if you're operating in, let's say, for example, if you're operating in California, and even though you set up the LLC somewhere else, you still have to pay the $800. But more importantly, they can make a good case, and I'll show you case A, B, and C, where they basically prove that you really weren't a Nevada corporation, you're really a California corporation. And that kind of a thing. You want to go to the next level. You're paying your experts to watch this stuff for you and get to the next level. You're not paying them to give you this basic advice and educate you about this basic stupid stuff. If you're doing that, you're wasting money. And some of them, the good ones, they'll just push you away, and they'll be like, yeah, no, you don't need it. They'll just push you away because they're like, the good ones that like are really ethical will just kind of push you away because they're like, you don't need my help. You need to go do TurboTax or whatever and figure out the basics. And then maybe I can help you, but but there's plenty out there. Like I remember this one like EA, enrolled agent guy, and just like, oh, paid him for advice. Oh, your corporation is a great thing. I'm like, really? Like, and it was just all a bunch of bull crap. And I'm just realizing like, oh, I'm just wasting money. And I didn't waste a lot, but I wasted like $300-400 for the guy to help consulting with my business. And he don't know nothing about his own business, much less my business. And just not a good use of money. So I think I've rambled on enough. And I think that's it for this one. So going back to circling around, we definitely had some volatility this week, but you look at the big weekly charts, it's not a big deal. Of course, the issue is many times really big corrections and crashes start with a week that's like, well, it didn't look bad, especially in the averages. Like you have the S&P, you have the Dow, and these are more stable averages. So, often this type of thing occurs where it's like the damage really occurs in the small cap and the mid cap stocks and the NASDAQ and the highly speculative. That's where the money comes out first. And that's where the damage is done first before it gets to the big ones. So that could be happening. But, I would just, of course, watch it. And if you're, this is not financial advice, so go talk to your financial advisor. And that's definitely what I would do, and like if I look at a week like this, still the averages weren't bad. It shouldn't really have been a down week. It was not a down week for me. I didn't make any money really, but I had some hedging and some little stuff. And if you're sitting there in your portfolio and you're down 30%, 20% this week, then gee willikers, you're not really diversified. And, like I was saying in one of my other videos, there's diversification of market cap of companies, of industry groups, of popularity. Let's say it like popularity in high beta, low beta. So you kind of want to look at that. So basically what I'm saying is if everything you're doing is on Wall Street bets and it's all stuff that like it's driven by, social media, maybe you want to have some stocks in your hands that are not driven by social media at all, that are not correlated to it, because that's where like some of the damage seems to be. So, all right, I'm done for this one. So peace. Have a good weekend, everyone. Talk to you later.